Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and you can find my newsletter at seanhyman.com. That's SeanHyman.com, or at logicalinvestor.net. Either one will take you to the same place. So the other is logicalinvestor.net. And there, I've got a sample newsletter for you that you can find in the Investing Basics section of the site. And the newsletter is $17 a month, and there's no contract, no commitment. You get monthly newsletters, buy and sell recommendations on our investments. It's true investing, by the way, so we generally hold investments for an average of 2 to 4 years. Obviously, some will be a little quicker than that, and a few will be a little longer than that. But that is what is to be expected because it's true investing. It's not trading. And weekly videos that go along with our stock positions where I track the progress of our stocks and give you my latest thoughts on them. So here's an example of a recent newsletter I did that was January 2020. And in it, I will teach some concept. Like here, I talk about Warren Buffett and the way he analyzes stocks and the way he thinks about stocks. And then I go through, and in this particular issue, I talk about how the market's overvalued and how we know that by metrics like price to earning multiples, where it shows how high the indexes are relative to the average earnings that they point out, that they put out, and how stretched that is. And so it doesn't mean that the market has to crash tomorrow by any stretch, but what it does mean is that the market carries way, way, way above average risks, whether that's the Dow Jones Industrial Average or the transports or the utilities or the S&P 500, the NASDAQ, Russell 2000. Doesn't matter. Any one of those indexes are very, very grossly overvalued. And then I look at a chart visually, historically, that shows these valuations and how they're at the high end of this price to earnings multiple range going back to the 1800s and how risky that is, and what even an average multiple is versus what it is right now. And then I go into a technical look and give you things that showed that were warning signs before the last market crashes and where we're at today and how some of those risks are just very much the same. And I also talk about the emotional and psychological phases of the markets going up and down. And of course, we are right here in a very greedy, delusional period where they feel that there's a new paradigm, and it's a very dangerous period for the overall market. And I show you how we maneuver that and how we are prepared even for that slide off. And then I talk about brokerage firms' goals to get assets in and to retain those assets. And so the teachings that you tend to get from brokerage firms sometimes are more in line with their goals and sometimes not always with yours. Then I give a recommendation. So in this particular issue, it was Cardinal Health, which is ticker symbol CAH. Now this one happened so fast for us. We are actually already in and out of that. And subscribers reported their returns to be anywhere from 11 to 16% within a 6 to 7 day period. It was crazy. We never have one that happens that fast, so don't even think that'll be the norm. And there's no way I could have known that would have happened ahead of time. But what happened was we got into Cardinal Health when it was beaten down. Investors were negative on it, yet it was very solid and its fundamentals were improving. And so we bought in, and they had an earnings report just days later. And since they had beat earnings by quite a bit, the market readjusted what it thought of the stock fairly instantly. And so we had a very, very quick profit on that. But that does not always happen. But we got a huge company, a $15.6 billion company. It's been around since 1979. It has a 3.58% dividend yield. They made $2.86 billion last year. Got over 1.2 billion in cash. So we talk about the fundamental conditions of companies because there's a lot of newsletters that buy a lot of fundamental junk out there, and we're not one of them. So you're going to know if something's solid or not. I'm going to break that down for you in plain English. Their debt levels are still healthy relative to their market cap or their size of their company, and I've shown graphically how the debt's even been coming down in the latest years. This chart shows how the earnings of the price of the stock relative to the earnings that it puts out keeps coming down. So the lower this goes, the cheaper the stock price is relative to the earnings that puts out. So a low PE multiple is so much better than a high one. So this multiple has been coming down over the years, and that tells you that the stock is getting a lot cheaper relative to its earnings. And then in this chart, I look at how Cardinal Health, its PE multiple, its valuation is compared to its sector, and it was far cheaper than its sector as well. So a lot of things really appealed to me here. And of course, I give a thing here where you can click on it and find out even more about Cardinal Health if you're not sure like what they do, or you want to find out even more information on that. So then I go to the technicals and I look at the charts, and I tell you why I believe now is the time to start getting into the stock, and why, because it's had paired back so far to bigger support levels and it's starting to break higher, and technicals indicators were strengthening, and even amongst the bearishness, and I give several scenarios of what could likely happen with the stock. This top one was the one that actually happened to just happen. It paired back just a little bit and took off, but that's not always the case, and we're prepared for any larger dips, and we take advantage of those by averaging down on our stocks in a very methodical way, which I go in more in the newsletter. And then I talk about why, even on the more near term on its daily chart, why I believe that it could be time for to get into Cardinal Health from a technical standpoint. Then I give a recommendation that'll be in bold, big letters. Buy Cardinal Health at a buy limit of 51.50, good till cancel. So in other words, if the price is 51.50 or under at that point in time in the newsletter, that means it's fine to buy it at or below that price, but not above that price. So they got in. We had averaging down points if we needed them at certain levels at 42 and 32. So there's no guesswork there. I talked about where I think that the stock could easily go to 65 or 66. And a little bit of that why. And then also, the only thing I leave out here is there is our portfolio of open positions that will normally be right here, which obviously I can't give that in the sample, or else that gives away all of our picks. And then here's our closed positions up to our last newsletter. So Cardinal Health would actually be one more added here. CAH, it was we exited after 6 or 7 days, and I went with more of a conservative price than what my subscribers said that they got, but I've got us down for 12.6%. Again, many of them, had 13, 14, 15, 16% even that they made in that particular time. But you can see some of our returns there, and on solid companies. So I just wanted to give a little bit of a idea there about, if you subscribed, what something might look like. Again, we have weekly videos. When it's time to sell, I send out a sell alert on the site, which if you have your notifications hooked up to it, it also sends you an email as well. And then additionally, I wanted to share one other thing. I had a subscriber recently share with me the growth of his portfolio. And again, I didn't solicit this. He just offered it and posted it to the forum board on the site, where we talk about our stock positions on a daily basis. And he started with $13,000 back in 2016, and the growth of his portfolio, and you'll see it's a regular growth of portfolio. That means it'll be up and down, along the way. It will have pullbacks in its balance and advances in its balance. But his had grown from $13,000 to $46,000 from 2016 to early 2020. And so again, I can't say everybody's will be exactly that, but I did, when I posted it on my Facebook page, there were a couple other subscribers that had seen it and chimed in and said, yeah, I've had similar results to that as well. So quite honestly, for a lot of people, if they'd have had half that return that this guy had, it'd have been a very respectable return. So he's paid the equivalent of what's roughly a couple $100 a year for advice that's given him stock recommendations that in his instance has turned his portfolio from $13,000 to $46,485. So again, that's a stellar return. So that's what one subscriber has admitted that he has had in it, and so I think that's just a phenomenal thing. But anyway, that's all I wanted to share with you today. I wanted to give you a sample of the newsletter and what it looked like, so that you could see that freely without any charge, see what a recommendation would look like, the format of the newsletter, etc. So you get kind of a taste and feel for what that's like. So thanks so much for watching. And again, come check us out at SeanHyman.com or logicalinvestor.net. Thanks so much, and God bless. Bye-bye.